This week, everything changed in markets. We're going to take a look exactly what happened and how I think that's going to shape up in 2025. And 2025 won't look anything like the last 5 years. Now, whether you're a detailed macro person or just interested in markets, I'm going to make this approachable and understandable for everybody on both ends of that spectrum. If you like this sort of content, like, subscribe, and you know what? What do you think Bitcoin's going to be at the end of the year? Comment down below. That would be awesome because, heck, I don't know. I have no clue. I put out videos like this a couple times a week, whether we're talking about systematic trading, whether we're talking about macro, whether we're talking about crypto. A couple times a week. You definitely want to subscribe so you get these. Love you guys. Let's go. So to set the stage, the first thing we're going to talk about is liquidity. This is, in essence, a tailwind for risk assets. When liquidity is in the system, prices rise, assets rise. So I'm going to start out with a quote from the greatest of all time, the GOAT, Stanley Druckenmiller, one of the best investors to do it. In the book by Jack Schwager, The New Market Wizards, which was written in 1994, he had this to say about liquidity. The major thing we look at is liquidity, meaning as a combination of economic overview. Contrary to what a lot of financial press has stated, looking at the great bull markets of this century, that would have been the 1900s, the best environment for stocks is a very dull, slow economy that the Federal Reserve is trying to get going. Again, he wrote that back in 1994, but if you just read it today, it certainly stands to the reason what we're dealing with right now. So the first thing we're going to look at here is our macro ops liquidity indicator. Okay, this shows the liquidity being pumped into the system by central banks around the world with a number of different methods, whether they're literally buying stuff and use, that money is going in the economy, whether they are backstopping things, whether they are providing loans to different loan facilities. There's a number of ways that they can really push liquidity into the system. So this indicator, we're going back to 2020. Okay, so we can look back to this goes back a couple of decades, but I just want to take a look at this period right now. So over here on the left, we had that big boom in 2020, that big crash in 2020, followed by the recovery into 2021 peak, 2022 bear market. This was not normal. Okay, everything that happened over here, not normal. Through the 2022 period, you can see liquidity completely dried up because you know what happened. They pumped a lot of money into the economy in 2020, 2021 with those stimulus checks and just everything that was happening. So as the economy started to recover in 2023, you can see liquidity started to creep up. You could look at an S&P 500 chart and see similar sort of pattern up, with the liquidity up, S&P goes up, we go into 2022, we pull back, and then we start to recover. And then in about 2024, so last year, the stimulus, this is global liquidity, not just the FOMC, this is around the world, global liquidity pinged up at that 100% level for the entire year of 2024. Thinking back to what we just read with Druckenmiller saying that central banks look as liquidity as a tool to help get a sluggish economy moving. And so as we're coming out of that that huge inflationary period in 2022 and that 30-something% pullback in S&P, they needed to stimulate the economy. And so they did it in a number of ways. One way that they didn't really start doing it was cutting interest rates. So while they really aggressively started to raise interest rates back in here, they only cut interest rates. The first cut was over here in September of 2024. So they were doing something else. They were injecting liquidity in the market to get it going, get it out of that sluggish way that it was flowing into a more growth oriented economy where businesses could there was demand for product. People weren't like tightening up their spending. They weren't so worried about not being able to pay bills. So they're starting to get into the economy again. Now, the correlation of liquidity happens. It's actually pretty easy to see. This is a chart Anthony Pompliano posted in or sent in his newsletter earlier this week. I grabbed it because it was well done. You can see the white line is global liquidity, and you can see that let's call it yellow. I don't know, maybe orange. That's S&P 500. So as liquidity dies down, S&P 500 dies down. As it rises. And, you can see that all through 2024, it pretty much just rose. And that was a big move, right? Coming from the lows in October of 2022 really came out of it. But there was a bit of a crisis in 2023 with the banking, Silicon Valley Bank blowing up, and it was a banking crisis. So you can see it kind of, that liquidity was not as they would have wanted it to be. It was a bit of a shakeup there, but eventually things cooled down. We get into 2024, and it goes pretty well. So you can see that it is very equity prices are very reactive to this global liquidity. So looking at like where we are right now, this is the S&P 500 for the last quarter or so, from the interest rate cut by the Federal Reserve in September to this is where they FOMC meeting happened in December, where they said, okay, we're done. It's not we're not going to keep cutting rates nonstop back to zero. We're kind of easing up. We're keeping our eye on inflation. We don't want to let the inflation boogeyman back out or criminal out of jail or whatever it is. And so we're going to start easing. And if you recall, global liquidity had eased going into this period as well. So it was going into when they stopped with the liquidity injection over here in like Q3, the end of Q3, Q4, they stopped the liquidity pumping into the system, and that's when they cut rates. So they deployed a new tool, which was rate cuts, and the market had just been holding out for rate cuts and to start going higher. They did. They went for a quarter, and then they came back and said, okay, we're going to cut one more, and we don't know what it's going to be like from there. That spooked the market. If you recall, December was a really big month, and more importantly, if you think about some of the assets, they way outperformed S&P 500, like Apple, like Tesla. There's a number of different names that were really rallying hard in December, while the rest of the market was kind of stale. Which brings me to the next point from Stanley Druckenmiller's quote in 1994. Like I said, once an economy reaches a certain level of acceleration, the Fed is no longer with you. The Fed, instead of trying to get the economy moving, reverts to acting like the central bankers that they are and starts worrying about inflation and things getting too hot. So it tries to cool things off, shrinking liquidity. Now, a reminder, this was published in 1994, right? It could, 30 years ago, it could very well have been said and pushed out yesterday, and it would have made the most sense in the world. So we're not talking about some obscure idea. This is what the central banks do. We're looking at about 80 years, it looks like, back into the 1950s of the United States CPI. And this is it's been adjusted quite a bit over those years to measure different things. So it's kind of hard to get it exactly right. But generally speaking, this is a pretty good measure of inflation. And what we can see, again, it goes back into the 50s here. We had huge inflationary period in the 1970s. This was one of the toughest periods post World War II to the economy, to growth, to everything. Interest rates went, you're looking at a inflation at 16% up there in the 70s. And then it wasn't until like 1982 or so that they actually were able to break the inflationary period. And look, since that period, we went all the way to 2022 before inflation really did anything different. And obviously it was measured different. They changed the measurements on it. There is certainly that argument, but you can clearly see that we had not had such a hot inflationary environment since the 1970s, and that happened in 2022 post bailout and all that sort of stuff. No bailout, but stimulus and everything that they did. And so, understandably, the Fed has been really, really focused on trying to put that inflation criminal back in jail. Now, if we line all these up together, we can see we've got Citi's Economic Surprise Index measuring inflation. This goes back to 2000. There was that, in essence, right now where we are, kind of looks like where we've been for the last 25 years, minus this period. Same goes for full service meals and snacks. Same sort of thing. Real big spike. Same sort of thing here. Wages and inflation went all cattywampus in that era. But we are kind of back to, if we just remove this spike and we see where we are today, we are in line across the board. This back to the CPI, back to the 1960s. We're generally at that level that we want to be at. We want, well, I don't know, if we can argue that we really want to have any inflation and all that, but that's a separate discussion. On Wednesday of this week, CPI print came out at 3.2%. It was expected to be 3.3%. It was basically a rounding error, but the market took the headline and went with it and shot up well over 1% on that headline in seconds. The Federal Reserve here, FOMC in the United States, likes to use PCE, personal consumption expenditures. So like you individually, what are you spending money on for consumption, like, food and that sort of stuff? Like that's what the Fed wants to measure as inflation being tame. And like the CPI, like the other charts we were looking at, we did have periods where this last period here, 2022 or so, inflation shot up pretty high and got right back down into it. You can see that the 70s is where it was happening. These are mostly recessions. Okay, this was the global financial crisis. So you can see that generally speaking, personal consumption is right in line with what it has been for about 80 years. I'm sorry, that's 60 something years, not 80. And so like Druckenmiller said, what the Fed wants to do is they want to stimulate the economy with the liquidity being pumped in there, and then they want to ease off and let what they stimulated, all the work they did, they want the economy, they want businesses, they want people and companies to create growth and grow the economy more organically. They're using that incubation period, or maybe like when your parents, not mine, but parents say, hey, we're paying for college and you're great. You go to school and, bills are paid for, you got a car, you're kind of doing that sort of stuff. And then as you get out of school, you get a job, your parents are like, okay, we're done. Let's see how you do. That's kind of the idea here, is that the central banks are going to inject liquidity. They're going to stimulate the economy to get everything going, kind of kickstart everything. And then they want that to just, they want to taper their business down so that they can kind of rebuild their, keep their powder dry. They want to have something to be able to come in and deal with any, wild market conditions that they might have. And what we're looking at right now is the possibility of a Goldilocks economy. And when we say Goldilocks economy, that's when the ISM, the growth is above 53%. So currently we're below that, We want to get to where the economy is growing organically above 53%. And we want to do that without inflation. So CPI below 3%. We're at 3%. That's in essence a Goldilocks economy. That's a high growth, low inflation. Let's go, let's go, let's go. That's what we're aiming for. That's what the Fed's aiming for in this period, so that that we can really stimulate the growth of the country and not have to continue to print money and have this central bank intervention. We want to do it more organically. Currently, the ISM is at about 49.3. You can see that it was artificially stimulated during this period over here, but not too far away to get that 53 if we really keep doing good. So now we get to the discussion of how the market is going to start looking going from here. I started this video, I said everything changed this week. This is the part this is where it all starts to make sense of what changed and how we're seeing those changes in the market. This is the 10-year notes interest rate, okay? Down at the bottom, I wrote where the FOMC cut rates. That was in September. And even though they cut rates, because everybody anticipated it, when the FOMC cut rates, interest rates on the 10-year shot up like 120 basis points. Just went on a tear from September to just this week. Just straight up bid. It was a surprise, right? Interest rates rising while the FOMC is cutting rates. It's because I guess bond speculators, whatever, are speculating that rates were going to be held higher for longer. So the next thing we're looking at, again, this is the 10-year, but I added my SQN indicator, my market regime indicator, which is across the bottom there. That's that histogram number line looking thing. And there's a couple of things. I use it for understanding what's happening in the market and what could potentially happen. Okay, this is a price, rate of change, and direction indicator. It's a lagging indicator. It's not meant to tell you on the absolute given day exactly what's going to happen. It's more like a calendar, right? If it's January in Montana, you're not going to have to worry too much about getting too hot, right? Temperature is going to be mostly frozen. There's going to be a lot of snow, and you're not thinking too much about tank tops and flip-flops. All you're thinking about is just being cold. Opposite is true. If it's July in Arizona where I live, the last thing you're thinking about is getting very cold, except from air conditioning, right? It's definitely tank top and flip-flop weather here. And so you don't need to even consider the other possibilities that might be out there. That's what this tool is about, okay? It says, like, I'm not worried about a major top happening anytime soon or a major bottom happening anytime soon until I see this. And it's the bull volatile regime, which is the blueprint over here on that. The bear volatile, which is the opposite direction, and it's that dark crimson red, okay? When you get blue, after it's been pushing up higher, this is where a reversal is available. It doesn't mean that it is inevitable. It doesn't mean that it's going to happen right away. It doesn't mean that, that's the signal. This is a lagging indicator, so it takes a while for things to happen, but it is very much a measure of fragility of that price level. And the fragile part of it is when prices move too far too fast in one direction, they skip over a whole bunch of things, okay? So that fragility means like, wow, we went from 3.6 to 4.8% rates way too fast, way too fast. We're going to have to we cannot sustain this anymore. There's, I would love to buy treasuries at 4%, 3.8. I don't know that buying it, it's kind of, we got to go back and find different levels. This is rates, so it's different than actual price, but it still shows up in here. But I want to get a little bit more focused on where. So we see it here in in the 10-year. We did get our reversals as well in 5-year, the 30-year. So across the U.S. rates, Treasury complex, we got to volatile levels in price. So if I was to put the bonds up here, not the yield, would be inverse, so it'd be upside down, and you would see same sort of thing, bull volatile or bear vol at that time. So it'd be reversing. So the price of the bonds go up while the interest rate of the bonds start going down. That's what we're expecting. And this is why it changed this week. This is the US dollar index, the Dixie. Okay. This is the exact scenario. We just topped over here. We got our bull volatile top signal regime here. We did not have any clear direction that we were going to reverse anywhere since September. It just went straight up. And that looks exactly like the 10-year yield that I showed earlier, just straight up, right? This one went from about 100 to 110, like a 10% move in the dollar. That really has major effects around the world. And, you can see back in 2022, it was at very high levels as well. We got our bull volatile reversals, and you can see it took a while, but we eventually started that reversal. I don't believe it's going to be as volatile around that reversal type level. I just think that we are in a position where the opportunity to stop going up on the dollar is there. And so we'll see the opposite in other currencies around the world. This is the Canadian dollar. When you're long the US dollar and short Canadian. So you're long one and you're short another. So if you had Canadian dollars and you sold Canadian dollars to buy US dollars, you're short the loonie, long the dollar. And so you would expect to see a declining currency against the backdrop of the dollar being high. And that's what we saw. Since 2021, the Canadian dollar has just dropped. This was one of our big shorts we had in Q4 of 2024 at Macro Ops. And you can see for the first time in 4 or 5 years, we printed that bear volatile. And it's a big move. And this was where it got really big, right? This is where that price capitulation, the rate of change and the moves were so fast that it causes that print at this level. And then that indicates a reversal. You see it over here in March, April of 2020. Same sort of thing, just too far, too fast, reversed, and really just went on a tear into 2021. So across the board, we have that stimulus strength, right? The liquidity dying down a little bit, the growth of the economy hopefully kicking up, keeping inflation down is what we're really hoping for. And you can see Bitcoin is usually one of the best benefactors of the liquidity cycles in these growth type environments. And in 2024, it blew away NASDAQ. NASDAQ up 29% or so. Bitcoin up 130 plus percent. Bitcoin is probably one of the easiest assets to trade within the macro universe. It's very reactive to liquidity and growth. So that period that Druckenmiller talked about, where they stimulate with liquidity, and then they hope that carries over into a growth cycle by the economy. This chart, basically Bitcoin is that. It is the asset that historically has done the best in that environment. And so I want to be long the things that are going to benefit from that. Bitcoin has certainly benefited from that, and I believe it will continue to benefit from that in 2025. I don't believe the top's in on Bitcoin is maybe a simpler way to say it. But if I'm using a macro framework, this is where I want my, a portion of my capital is to be benefiting from that environment. Now, this is another correlation of Bitcoin to the M2 money supply, which somewhat global liquidity measurement. And one of the questions people have is like, well, liquidity is being pulled back, Chris. Why would that be? How does that make sense with what you said about liquidity and Bitcoin? Well, Bitcoin is a beneficiary of just better economic conditions, even if they are central bank stimulated. They benefit from the rise in asset prices. And what we can see here, I put this line up on Bitcoin. In October of 2016, Bitcoin was trading at $629. Immediately after they cut liquidity into 2017, and by the time that they started back up again, so when they came back in and started adding liquidity, the price of Bitcoin was at $1,000, over $1,000. So, like I said, the liquidity benefits Bitcoin, but the growth from the liquidity benefits Bitcoin quite a bit. And of course, if you recall, 2017, Bitcoin it made it to a high of $20,000 during that growth. Okay. And then, of course, as we can see here, when it starts declining in 2018 was kind of a bit of a rocky year. Bitcoin certainly felt that. You can see that it goes all the way down into the 2019, I believe, period, more or less, is where it bottomed. And that kind of correlates. You can see that stimulus started to come, or liquidity starts coming back in, and that continues the Bitcoin roller coaster. So it's actually a very good way to follow along the price of, like seeing the future price of Bitcoin is the correlation with these. Speaking of correlations, this is the chart that has been guiding me since October of 2023 when I got long. We in the crypto momentum system, it fired the macro buy signal for crypto. So when Bitcoin was trading at 28,000, it's currently at 105,000 as I speak. We got our buy signal. That was like right over here. Okay. So the white line is where we currently are. Okay. We're right here. We're about 470 days. I don't know exactly days into the bull market. The yellow line is the 2016 to 2018 bull market. And then the blue line here is the 2020 to 2019 to 2021 bull market in crypto, Bitcoin. These are Bitcoin prices. This horizontal area over here is the halving, and I tried to line those up kind of as best I could. They give or take here, there, off, but for the most part, it's lined up pretty good. And this, like I said, this chart has guided me through the big rally we had a big rally up into the ETF crash. And then February through April, we had a big rally in Bitcoin going from like 40 to 75,000 or so. And then all the way through the summer into the election period. And then we, had that big takeoff, and it has lined up pretty well. And I just want it to line up generally with what it's done previously. I'm expecting it to continue to follow this yellow line. Okay, that's certainly bullish. That would be convenient because it's the most bullish outcome of the two. And we're going to see. We're going to see here. We should see here pretty soon if this, in either case, actually Bitcoin should take off higher from here. And if that happens, then we're going to see, is it going to continue? So that would have been about 3x higher from here. So let's call it 300,000. I'm sorry, 350, 400,000. Yes. 2x would be 200,000. So somewhere around 300,000, I think is the number. And so we'll see if this one is the case. Then yeah, we have a 300,000 Bitcoin ahead of us. If it's not, well, maybe it's just a 200,000 Bitcoin ahead of us. And if it just breaks completely from this analog, well, that's great. We don't need the analog anymore. We'll find a different guide. But so far, it's been really good. The thing about trading crypto is you kind of have this barbell of people. You have the crypto folks who are kind of more just want to trade, and so they have there's a lot of technical analysis used and a lot of narrative to guide that group. And then you have, the big picture macro crew, and they're more positioned to, okay, we're in a place where Bitcoin is what you want to be in. I don't really know where it's going. I don't know where I want it to be. I just want to be in it because it is the best performer. We'll go back to our little NASDAQ. If you had a choice to be in NASDAQ or Bitcoin and with no leverage and it was just an exact dollar amount, you would have wanted to be in Bitcoin. And that's what it is. That's how the macro play is. There's no real in my opinion, I'm not putting price targets out there because they're not going to help me. I'm going to look at these macro environment conditions to see when it's going to be favorable and when it's not favorable. So I want to put risk into Bitcoin when it's favorable. When we get to the point to where it ends, right? That's where you want to see, maybe this would help guide us. This analog may help guide us about that. But I will be looking at the economic conditions, the global macroeconomic conditions, to see how they line up and where that might affect price from here. So let me know what you think is ahead for 2025. Go ahead and, I don't care, drop your price predictions down there. It'd be awesome to see what everybody's thinking. If you are interested in this sort of stuff, like I said, like and subscribe. Go to macro-ops.com. Get signed up for the free newsletters. We put all sorts of information like this out throughout the week, multiple times. And if you'd like to learn a little bit more about how I trade crypto and I share my crypto momentum system over there, you can get that. If you like, it's macro-ops.com and /crypto. And you have access, or you can see what it's all about, see if you're interested in it. And that's a wrap for this macro update. I love you guys. See you next time.